In the dynamic realm of trading, three critical timeframes emerge as cornerstones of market analysis: direction, behavior, and entry. Each timeframe serves a distinct purpose, empowering traders to grasp the nuances of market trends and make informed trading decisions. These varying timeframes cater to different trading styles, illustrating the versatility needed in the market. For instance, intraday traders often rely on 4-hour, 1-hour, and 15-minute frames to refine their strategies and align their moves with market fluctuations. In contrast, scalpers, with their rapid-fire approach, opt for even shorter time frames. They typically employ a 1-hour frame to establish market direction, a 15-minute frame to understand behavior, and a swift 5-minute frame to pinpoint their entry opportunities. Shifting focus to a larger time frame, such as the 4-hour chart, provides traders with a panoramic view of market trends, thereby mitigating the confusion often wrought by short-term price movements found on smaller charts. Moreover, prioritizing recent market behavior over outdated charts is paramount. This approach aids traders in decluttering their analysis, thus enhancing clarity in their decision-making processes. Equally important is the practice of marking key high and low points within a consolidation zone. This technique is instrumental in determining potential market direction, serving as a foundational step before executing trades based on candlestick patterns. Diving deeper into analysis, the significance of scrutinizing multiple timeframes cannot be overstated. This practice allows traders to pinpoint the overarching trend direction, subsequently preventing the confusion that often arises from conflicting signals between different time periods. Furthermore, recognizing price retracements or pullbacks on higher timeframes plays a critical role in effective trading. These movements may manifest as downtrends on shorter timeframes, potentially misguiding traders if not carefully observed. In this context, waiting for confirmation before entering a trade becomes essential. Traders should ideally enter a buy position only when the price transitions from bearish to bullish on the 15-minute time frame, ensuring a disciplined approach. Transitioning from a 1-hour time frame to a 15-minute time frame further clarifies trends, unveiling momentum shifts that hold significant implications for trading decisions. It is crucial to await alignment across multiple time frames before committing to a trade. Such patience aids in avoiding impulsive decisions while ensuring a robust trading setup. Identifying swing highs and leveraging them as target levels can significantly enhance a trading strategy, particularly when analyzing previous areas of resistance. Utilizing advanced tools like TradingView can elevate a trader's experience, providing access to premium features and detailed analyses of past trading history. This analytical prowess enables traders to identify and rectify mistakes effectively. Starting an account with a reputable broker often comes with enticing perks, such as zero account maintenance fees for the first year and no hidden charges on trades. These incentives can substantially reduce overall trading costs. Moreover, understanding risk-reward ratios is fundamental for successful trading. By strategically placing stop losses and awaiting price confirmations, traders can mitigate unnecessary losses amidst unpredictable market movements. Expanding the view to longer timeframes allows for the identification of strong demand zones, thereby fostering more informed trading decisions. Recognizing these zones can significantly enhance entry points and fortify risk management strategies. Confirmation across multiple timeframes, including 15 minutes, 1 hour, and 4 hours, substantiates the validity of a trade setup. This comprehensive multi-timeframe analysis is vital for navigating the complexities of successful trading. Lastly, the practice of backtesting strategies stands out as a crucial element in ensuring their effectiveness prior to live trading. By testing in a simulated environment, traders can fine-tune their techniques, paving the way for improved outcomes in the real market.